Hello again, everybody. Welcome back to Accounting 1101. If you've been following along, you know that we've been talking about how to deal with uncollectible accounts, how to deal with them from an accounting standpoint. In our previous video, we went through and talked about the direct write-off method, which was a way that we can kind of write off an uncollectible account when it happens and when we discover that it will be uncollectible. In our video today, we're going to talk about the allowance method. The allowance method is actually the one that we use in GAAP, Generally Accepted Accounting Principles. So it's a little bit more involved, but it's important that we know it because, hey, that's the methodology we use in real life. So in our video right now, we're going to talk about the allowance method. We're going to show you how to use it. Now, we still use the bad debt expense account. I introduced the idea of the bad debt expense account in our video before. Bad debt expense, simply an expense reflecting uncollectible accounts. Okay, as our failure to collect that account leads to a bad debt expense, cost of doing business. Under the allowance method, we recognize bad debt expense by estimating the uncollectible amounts and then making an adjusting entry. Okay, that's different, isn't it? The direct write-off method, we didn't hit bad debt expense until we knew a customer wouldn't pay back. Now, we're estimating the amount of uncollectible accounts kind of as we go along. And we make an adjusting entry at the end of the accounting period to reflect that amount that we think won't get paid back. So the direct write-off method, we know they're not going to pay back. Under the allowance method, we're making estimates based on what we think won't get paid back. So here's our scenario. We have DPS Company. They began operations in August, and the end of the period is 12/31. On 12/31, they had $200,000 in accounts receivable, and they estimated $30,000 of that would be uncollectible. So let's talk about that $30,000. First of all, it's an estimate. That could be based on the industry average. It could be based on experience. It could be based on a lot of different things. There's actually a couple different ways that we can estimate that uncollectible amount, and I'm going to do a separate video on those, so be on the lookout for that. Let's talk about the accounts that make up that $30,000. First of all, we don't know. It's an estimate. It's not necessarily based on specific accounts. It's based on the balance overall. We don't know for sure which accounts won't be collected. Because we don't know for sure which accounts won't be collected, we can't write off a specific account like we did in the direct write-off method. You remember in our previous video, we had old Mark, and we knew he wasn't going to pay us back. So we wrote off his account. But now, we don't know specifically which ones are not going to pay back. We just estimated. So we need a new account here. When we did the direct write-off, remember Mark didn't pay us back? So we debited bad debt expense and we credited his account, credited account receivable. Well, now since we don't know which ones aren't going to pay, we're just making an estimate, we need a new credit account here. We need a new account to credit. We can't credit the account receivable, specific ones. So here's our new account to take care of that. It's called the Allowance for Doubtful Accounts. And this is a contra asset account. You might remember the accumulated depreciation account was a contra asset account. This is the exact same idea, only keeping track of account receivables that may not get paid back. Okay? So the allowance for doubtful accounts is a contra asset account. Works in the opposite way of other asset accounts that reflects the total amount of receivables we estimate will not be collected. All right? This account is going to offset accounts receivable to give us a net amount that we expect to collect. So here's how it's going to work. On December 31, DPS estimated $30,000 in uncollectible accounts, recorded an adjusting entry. There's our bad debt expense. That part's the exact same as it was in the direct write-off method. The difference is our credit account. Because we don't know specifically which accounts that's going to hit, I can't credit account receivable and take it out of the different individual accounts that make up account receivable. So I've credited allowance for doubtful accounts to record that estimated amount. From a financial statement framework, you can see that allowance for doubtful accounts is reducing the asset side. It's a contra asset. It's also that bad debt expense over here on the retained earnings side, hurting retained earnings. And you can see we picked that up on the income statement. So we've recorded $30,000 of bad debt and hit that allowance account and put it in there. If we take our accounts receivable, if you remember it was $200,000, and we subtract out the allowance, we get something called the net realizable value of AR. Realizable value means the amount that we expect to collect. We expect to collect $170,000 of that account receivable. So that contra asset is bringing down accounts receivable when we net them together. Okay? $200,000 account receivable minus our allowance equals $170,000 net realizable value of AR. And oh my goodness, think back to the balance sheets. Remember all the balance sheets we looked at? Meta, Amazon, Disney, all of them said account receivable comma net. Guess what? That's what they were talking about. That net refers to the fact that they've already subtracted out the amount that they've estimated to be uncollectible. And if you read through the notes on the financial statement, you can see that amount. Isn't that amazing? We learned something here. The net is net of amounts that they don't think they're going to collect. So we can still write off a specific account. Even though we've estimated and made an allowance, if we know someone's not going to pay us back, we can still write them off. No big deal. On January 21, DPS writes off a $6,000 receivable from Bob Bailey. The way we write it off, we just debit that allowance. They've proven they're not going to pay. We don't need to allow for that non-payment anymore. We don't need to estimate it. We don't need to allow for it because they've proven they're not going to pay. So we take out $6,000 out of that allowance for doubtful accounts. You say, well, wait a second. What about bad debt expense? Why wouldn't we hit that? Well, wait a second. We already recorded that bad debt expense when we made the allowance, right? Don't need to hit it again. So we take it out of the allowance. They've proven they're not going to pay. We don't need to allow for it. And we credit the account receivable now that we know exactly which one's not going to pay. We can go into the subsidiary ledger of the accounts receivable, write that one off, and the account receivable balance will come down as well. So that's our entry to write off in the allowance method. You can see from the financial statement framework, accounts receivable goes down $6,000, and that nets out against our allowance for doubtful accounts. So let's take a little bit closer look at that allowance for doubtful accounts because it's a pretty interesting account we've got going on here. I guess if an account could be interesting, I don't know. I think it is, but I'm an accounting nerd, so what do I know? It's a contra asset account. Works in the opposite direction of the other assets. It lives on that asset side of the balance sheet. Has a debit side, it has a credit side, obviously. When we made our allowance, when we first booked that bad debt expense debit and credited the allowance account, that credit side of our account is all the estimated uncollectible amounts. Okay? Those are the estimated amounts that we think won't be collected. On the debit side, you remember when we wrote off a customer's debt, and we wrote it off, it was a debit. We debited the allowance account. So the debit side of that account reflects all the known uncollectible accounts. In other words, the amounts that we have written off. Credit side, estimated uncollectibles. Debit side, known uncollectibles. And when we make that adjusting entry at the end of the period, we're always going to be left with a credit balance. Okay, a credit amount of estimated uncollectible amounts. Reversing a write-off, if that customer, again, if they somehow become a zombie and they pay us back after we wrote them off and left them for dead. Nancy Smith has an account of $5,000 written off on April 2nd. It's collected on June 10th. We'd put it back into receivables and we'd have to throw it back into the allowance account. All right? So we reallow for it not to be collected. And so a lot of, if you think about what we're doing here, the allowance method, you'll notice we're using that allowance account. Didn't see that in the direct write-off method. So next time, we mentioned that at the beginning of our little scenario there, that the company had 30,000 estimated uncollectibles. Where'd we get that number? The book just gave it to us. In our next and final video on receivables, we're going to talk about how do we estimate that uncollectible amount, because there's actually a few different ways we can do it. And there's a rhyme and reason behind it, and there's a process behind it. We don't just willy-nilly sit back and say, I estimate that 30,000 will be uncollectible. No. We can't do that. It's accounting. We got to have a procedure. I'll see you back here next time to talk about that procedure. Until then, take care.